the Growth Capital and Crowdfunding for Startups SCRA webinar. I wanted to go over a couple of housekeeping items with you first. Today's webinar is being recorded and will be emailed to all registrants within the next business day. Also, feel free to ask any questions throughout the progression of today's webinar by typing your question into the Q&A chat box. Today's webinar will be presented by two experts from SCRA's Resource Partner Network and co-founders of Vicinity Capital, Josh Rollins and John Crawford. Josh has an MBA in finance and is a certified management accountant at Vicinity. Josh has developed technical acumen in the early market of regulation crowdfunding and funding portal technologies and tools to support the new capital formation and investment opportunities. John is an experienced entrepreneur who has started and grown multiple ventures with varied structures. At Vicinity, John leads the sales, marketing, and strategic partnership development to align the value Vicinity can bring with the capital facilitation needs of both issuers and investors. So I want to welcome to the webinar Josh and John, and I'll let you guys take it away.
All right, great. Thanks, Andy, and good morning, everyone that's on here. We're excited to be here with you and present a little bit on what's going on in the space that we're in and exactly what it is that Vicinity is and what we're doing. So look forward to going through the presentation, but more importantly, look forward to taking questions and kind of opening up for conversation. So I'll start with the presentation here and roll through it, and then we'll take it from there. So at this point, Andy, stop me if for whatever reason you can't see my screen, but I think we should be rolling here. So first, to start with what Vicinity is. So we are a registered funding portal with FINRA and the SEC. We're the only active funding portal located really within the Southeast. We're based out of Greenville, South Carolina. So we are an online marketplace that has a physical presence and a physical focus to match local investors with local businesses that are raising capital. So the goal here is to connect through our technology platform and through the securities exemption that we use, investors who want to, who have local pride and can become brand ambassadors for the companies they're supporting and they're investing in. And this can help startups, real estate, Main Street businesses that are serving, have their compelling story, and are able to recruit their investment from their communities. So this started really as John and I were focused. He and I have worked together for 12 years in a variety of different capacities with business, but as we got into Vicinity, this was really largely around this shift that has occurred in the investing world, where traditionally private markets have only been accessible to the wealthy. Entrepreneurs that are trying to get off the ground really need the right friends and family in order to have the wealthy uncle who could get them that early capital. And then if you're a retail investor, which is 95% of the population, you're limited really to investments such as Wall Street, your 401k, which is pretty dehumanized and anonymous. The new world that we've shifted to really opens up access to all. There's a level playing field that's been established. It's more transparent. There's an opportunity to focus more on what your dollars are actually going towards, that you're investing in, and that impact focus. And it expands your community to be a part of the friends and family that can help your company get capital. And there are examples that we're seeing out there in the world today that really are paving the way to this. So you could look at somebody like Robinhood in the public markets. Good or bad, they are offering a level of democratization in capital. In real estate, you have Fundrise, and then the cryptocurrency movement, as well as the last two bubbles over here are what's going on in the funding portal world. So there's some that are focused very heavily on the moonshot Silicon Valley startups. Republic, WeFunder are examples of that, and there's others that are focused more on how you can help the Main Street businesses and maybe even a community bank sort of replacement that's tech enabled. So all of these, though, have a common center point of opening up access. The reason this trend is happening is largely due to a loss of trust. So millennials, my generation, maybe some on this call, there's a lost faith in traditional investments. Many millennials are moving away from that as at least their only avenue, and almost 2/3 of high net worth millennials prefer to invest in physical assets over the traditional stocks that they would have access to, and they're willing to accept a higher risk or even a lower return if investments create a positive social or environmental impact. Part of this trust is also seen. One of my favorite resources is the work that Gallup does in their research, and they had a net positive poll, which effectively takes those that have high confidence, subtracts those that have low confidence, and you get a number, positive or negative. Those in the middle don't count towards the poll. So the confidence in big business, according to this poll, was a -5. The confidence in banks is a +8. That makes banks look good compared to big business. That's a little surprising. But both, when you compare them to the same poll with small business, you see that the confidence in small business, the trust there is a +61 on the same scale. So this shows the trust that's cultivated between citizens within a small business and more local context. So for those of us that are entrepreneurs that are looking at business and how we serve, money is going to follow that trust. That's core. That relational capital is core to how people spend and think and serve in the business market. So looking at shoppers are willing to pay more when they're looking at local alternatives. This is at 82% today, where if you go back 10 years, the buy local, eat local movement was really more kind of crunchy and granola. Now it's very mainstream. You see this also in decentralization around accelerators and those that are able to support small business communities and entrepreneurial communities. That's not just aggregated in the large city centers like the West Coast and New York and others. And you have this exodus, actually, this active movement away from some of the big cities as the only places to go for the opportunities to build business or to build a career. And while we see that shift in trust, that trend, what's really enabling this to have a array of solutions is what's gone on in technology, and also what's gone on from a legal standpoint and the regulatory standpoint. So financial technology, whether you're looking at banking integration, blockchain, white label platforms, and low-cost customization, this has all enabled a variety of solutions, including opportunities like crowdfunding and crowd investing. The regulatory side is really what put the final puzzle piece together to allow this new investment mechanism and capital raise mechanism to be there. It started with the Jobs Act in 2012, but the particular area of regulation crowdfunding, or sometimes called equity crowdfunding, or what I like to refer to as crowd investing, this took what used to be just donations-based or rewards-based, like GoFundMe or a Kickstarter, and opened up the door with Title III to make it actually usable at a securities level, where you can have investments, whether debt or equity, facilitated through a securities exemption. So to date, just since it was late 2016, really companies started using this regulation in 2017. Over 600 million and counting fast has been raised through Reg CF, and there's over 1 million investors nationwide who have participated. This really does level the playing field and open access for all investors, where unaccredited investors, that 95% of the population, can invest alongside those that are the higher net worth that have had access to really whatever deals since the SEC is established, going back to 1933. So where Reg CF is today, there have been continual improvements in the regulations. Some of those include the raise amount that started at $1 million. It's now up to $5 million that could be raised by a company, by a particular issuer in a 12-month period. Accredited investors can participate freely with no investment limits. Unaccredited investors can participate. They do have limits based on income or net worth, which are fairly easy calculations that are actually done through our technology and to help make sure that people understand what they're getting into and what they're allowed to do through the exemption. Additionally, companies can use tools like testing the waters that allow for marketing their business, their raise prior to doing a full securities filing and exemption. This really allows for a lot of traction building and some momentum, engaging interest before having to go through some of the costs and effort of the actual filing. And then there's additional vehicles like the crowdfunding SPV that can streamline cap table management and can make for a clean and good opportunity for a variety of different businesses to use this special purpose vehicle instead of having necessarily a list of investors that all hit their operating company or their cap table. So what we see in the realm of local crowd investing is the opportunities this provides for a diverse array of small business owners. There's a lot more access. This really does allow for if you have a good idea and you have a network around you that wants to come around and support it and actually vote with their dollars, the doors are completely open. It also opens up for investors wealth creation opportunities, not just for those that are already wealthy and have had access to the private markets, but for those that are able to learn, assess, and invest even earlier on in their economic journey before they hit those financial milestones of being accredited. And then from an economic impact, the connecting local dollars to local businesses supports what's called the multiplier effect, which drives both the effectiveness of the same dollar spent at local businesses much higher than a dollar that would be spent at a corporate-owned peer. So this has, you can see this with Harvard Business Review and even the Atlanta Federal Reserve Bank that have posted stats around the positive correlation between a density of locally owned businesses and per capita job growth, as well as locally owned businesses and per capita income growth. So with Vicinity, to get a little bit more brass tacks, what companies are a good fit for a model like this? One thing, being past the MVP, being in that post-revenue stage where you have a local champion or lead investors to build momentum off of, it's a huge indicator in a model like this to be successful. But specifically with us, with Vicinity, with connecting to a local legion of investors that are in a tighter geography, this is going to be a solution that resonates with the community on the need that's being met, on the market opportunity that's there, and having shared values that make investors want to support it. Additionally, the business itself would want to use us, would want to use this because they would benefit from the brand ambassadors, the vested brand ambassadors that are there when investors are placing their dollars here. Additionally, the publicity of having a public raise, and also the local marketing that's there. What it allows for, also with removing headaches from the business, but also offering good opportunities to investors, is a friction-free process where through the technology, funds flow is handled, subscription documentations are handled, and also there's, as I mentioned before, the special purpose vehicles that can streamline the process. The compliant, compelling offering is done on the technology portal with the offering page that we would build and also the disclosure packets that allow for this to be compliant with the SEC and build trust with those that are investing by having that third-party intermediary that's facilitating the deal. And then there's opportunities to interact directly with the investors and the issuers. That can be through webinars, through forums on the page, but this is more open access to give the business the opportunity to build trust with those that may want to invest, but also open up that access to investors. So some examples of the offerings that are coming through our platform. There's been real estate investments that have a strong community resonance with either the businesses that are going in those buildings or the project itself, adding value to the community, to the block. Restaurants can use this. There's creative debt tools that can be used in this way, where there's a share of revenue, where there might be a business that's not necessarily looking for an exit, but is building a positive cash flow, profitable business, and can share. Additionally, tech startup is an area of resonance. There's platforms that focus very heavily on that. Our focus is for those that this one that we're looking at here had a strong resonance with their community. Their early users were in their community. Their early investors were in their community. So using that as a ripple point was very appealing and beneficial to Gulo. And then craft production is another example. So a wide array of businesses can use this, and there's a variety of structures that can be used and have been used in these types of deals. So where we view Vicinity, particularly in this space, we've talked a little bit about the market and the tool itself that's created through the regulation, but Vicinity really, we view ourselves as the missing link between this democratized finance movement and also this new localism, this desire of people to be able to keep dollars closer to home, to invest where there's higher transparency and trust, and to do that with a tech-enabled platform that makes it easy and compliant for everybody. So we're committed to the economic vibrance, mobility, and resilience that can be built when people have access and are able to invest where they live. So I saw a question hit the Q&A. That is the end of the presentation. So great timing there, Heidi, on the question, and would love to see many more come through. We're happy to jump in and open up conversation at this point. All right, and John can hop in too. I've done a lot of the talking, so he'll be able to offer certainly some good perspective and answer some questions even better than me. So first question there from Heidi. I've heard crowdfunding can eliminate the company from SBA loans since all of the investors can't be documented. It's my understanding SPV creates one investor that signs for all donators or investors. Does SPV help get over the hurdle? That's a great question. So I know that the SPV, particularly with crowdfunding, it's a particular vehicle used only for this purpose. So it's not the standard SPV, but it is used exactly for that purpose, Heidi, of being able to allow one line on the cap table to hit the operating business. We've seen it, we've used it with a variety of other complex situations like historic tax credit investors, USDA guaranteed loans, and it has been a great tool to get over some of those hurdles. So while I couldn't comment on each situation, and there's a lot of intricacies with an SBA loan that may have some gotchas, but I do think it would be a useful tool and certainly be a conversation point that could be had with bankers to assure that that's not an issue that you'd run into.
Yeah. I see some here in the chat as well. I've got a question that says, how does Vicinity make money? So Vicinity makes money on the success or along with a successful campaign. So if a campaign is successful in raising dollars, then we get a success fee for that. Generally, that's a portion in cash. And then there is a part of that is the SEC allows for us to take compensation in the form of security offered to the public. So many times that might be a 6% and 2% in terms of the success fee. That's the main avenue to how we make money, our business model. Investors also, there's a small 1% fee on returns back to that come back to investors. It's essentially a transaction fee, so that's in there as well. It's generally the model for this space, and the percentages may vary, but that's in the neighborhood of what you would see on other portals. The follow-on question there was, how do investors exit their investment? Some of that might depend on the type of security. So if it's equity, that equity is dependent on a transaction, liquidity event, you might say. There is also, I won't get into all the intricacies of how you do it, but the equity can be sold And for unaccredited investors, they have to wait a 12-month period to do that. But the alternative trading system or a secondary exchange is not a mature area of this market currently, although there are ways that investors could exit their investments that way. And then if it's a debt instrument like a revenue share or a loan, those payments come back over the time period of the investment, and that's how they get their money back.
Yeah, and I just as a follow-on to that, there are, to John's point, there's not a liquid secondary market for this yet. It's a 5-year-old industry, but there are multiple alternative trading systems that are being created right now for exactly that kind of exchange. So there is the opportunity. There's no securities limitation outside of a few that John mentioned, where you're not able to sell as an unaccredited or to an unaccredited investor within 12 months. But outside of that, you are able to sell, but the market there is not developed. So usually it's whatever the terms of the deal are. If it's debt, it's when the debt's paid back. If it's equity, or if it's a future equity deal, it would convert at those milestones that the business would go through. So I see another answer here on what about films? That has actually been an area where crowdfunding has been used. It obviously has some specific components to it on the way the returns might be structured and the audience. I can't remember the name of it, but I think there's 1 or 2 funding portals that specifically focus on that niche, but it certainly can be used. Gordon, advisors are telling us not to do a Reg CF because it makes the cap tables too complex. Yeah, this was a concern that was there early on, and was addressed in a couple workaround ways over the years, but really was definitively addressed in March 15th, just of this last year. And that's the crowdfunding vehicle I was mentioning, those SPVs. It removes once and for all that issue of any kind of messy cap table concern, where investors are able to be aggregated in one LLC, and that LLC or company has an agreement with the operating business. So the cap table of the business is quite clean. There's one line there that represents the entirety of the investment through Reg CF. It doesn't. Okay, James, I'm going to read that question next. It doesn't appear that equity crowdfunding is appropriate for high-tech companies that have complex scientific inventions, such as an innovative medical device used in surgical procedures, as the local community would not understand its utility. John, you want to jump in on that? Or?
Yeah, I think, James, one way I'd answer your question is there's times at which I think that could be true. Think of Reg CF or regulation crowdfunding. It's just another exemption to run through. Instead of a Reg D, use a Reg CF. The difference there is the $5 million limit on Reg CF, and the fact that Reg CF is a conduit to bring more folks through. Is the unaccredited investor, especially, although there are provisions with certain Reg D offerings where you can bring some unaccredited investors through. So I would say if there is a complex scientific invention, and that's there, and there is some lead investment, call it smart money, if you will, where those lead investors are very aware and understand, and then the campaign itself could be put in lay terms, then it can allow for people around that smart money, if you will, to invest alongside. And so there's a sense in which it could be very appropriate for even something like the types of startup companies you're talking about. But I'll say again, there are times when that your particular scenario holds true, and it may not be the best fit.
John Blackburn, there's also a credit card processing fee for smaller crowdfunding campaigns. So if I'm getting your question right, if an investor is choosing to invest using a credit card, then generally, yes, there are fees that would be passed on. That's not a form of payment that has to be accepted. So ACH, or for larger investment, wires would tend to be the go-to, but a credit card processing fee would apply if if smaller there.
Yeah. I can, Thomas, your question is, what is the pitch mechanism for candidate companies? Is it a live presentation or more static like GoFundMe? So there's two ways I'd answer that question. One, as far as when the campaign is live, that offering is a live offering, and the form is filed with the SEC. The campaign page online has a monopoly, you might say, on the offering. So everything has to drive back to that page, and that page is static in a sense. It can have a video associated with all the relative information, documents associated with the offering are there. There is an interaction component there on the platform that allows for direct contact for question and answer to a business owner. So I'd call it a little bit more than static, but that does have that campaign page has a monopoly, you might say, on the pitch. That said, prior to going live with a campaign, Josh mentioned earlier, a testing the waters provision that the SEC allows for. And during that testing the waters period, there can be demo days set up and forums in which the owner is pitching a testing the waters page. And that can be a little bit more dynamic, interactive, and conversational. So combining those two, you get a kind of more of a holistic pitch process that you might see, within a Reg D exemption. There are advertising guidelines. Those are things we help owners with, guide them through that. So we're not out of compliance, and the issuer is not out of compliance in any way during the process.
The good thing is some of that is really dependent on how the issuer wants to approach it too. So like John was talking about, we've done, whether there's a video, there's the pitch that is held on the offering page, webinars that can be done to help interact directly with potential investors, and even events. There's creative outlets where the entrepreneur can be somewhat open to their style and their opportunity. To just all the information needs to ultimately get funneled to the offering page. That needs to be the monopoly of offering information should all be held there. Let's see. So I got Robert, I got a question from you, and I went ahead and just sent you my contact information. I think it's public there too, but with my email and number. So if you see that, would love to talk and see if we can be helpful there. And the Invest Where You Live t-shirt, yes, from an anonymous attendee. I do have some, so especially if you're in Greenville, but send me an email and I'll see if I can get you a t-shirt.
That was great, guys. I'm just gonna see if there's any other questions before we close things out. Looks like it. So again, great presentation, guys. I'm sure that was very, very helpful for a lot of folks out there. And thanks to everybody who attended the webinar. As a reminder, we just want to let you know the webinar has been recorded, and it will be emailed to all the registrants within the next business day. So be looking for that. There'll be a brief survey at the closing of today's webinar. Please be sure to fill the survey out, as it provides us with insight for future SCRA webinars. Also be on the lookout for future SCRA webinars, which can be found on the SCRA website under the News and Events tab. Our next webinar is going to be on Wednesday, July 8th, and is part 2 of our U.S. Patent Office series. So thanks again, Josh and John, for your insightful presentation. Thanks to everybody for attending the webinar, and hope everybody has a great day.